I'm Lex, and today on the show, Sandi West, her third time coming back. This is part 3. I love this. She's of Spider Academy. And interestingly, a floor trader like moi. We're going to go over a few floor trading aspects, but the main topic is going to be SPX and Spider vertical call spread. So we'll get into all this and more after the bell. There's the music.
What's going on?
How are you, Sandi?
I am doing good. How are you?
I love headbanging music. I love it. We're going to get that perfect. Don't worry. I'm good. Glad to have you back. This is number 3, I believe, right?
Actually, well,
Maybe
if you count the interview, it would be number 4. But
well, the series part. Let's call it
the
part
series.
3.
Yeah.
Series.
So our master classes.
That's right.
Yeah.
So I've loved them all. This is great. Always interesting. And, it's all also fun. You're a fellow floor trader like moi, which is kind of cool. There's not a lot of us around anymore. We all kind of crawled under the rocks, I think.
Yeah, not many of us left.
I know. Although I don't do it anymore. I wish I could, but I don't. So I'd go back in a heartbeat.
Oh, yeah, me too. I wish I could.
All right. So we're going to talk, first of all, before we get into the spider strategy, hand signals. So my question to you is, how in a large pit like the ones you may have been in, I wasn't in a large pit, how do you communicate your trades across the pit to another trader? Because you have to have some sort of identification, how many trades you're doing, what's your badge number or badge, not number, but your badge, who you clear, right? All that kind of good stuff.
Yeah, we were signaling lots of information. So when I started, I was in the Euro options pit. So the guys on the desk, they're the ones with the orders, right? So they're on the phone.
Yep.
And I was in the pit. And so they would, signal down to me looking for a specific option strategy and where the market was. So I don't know if your signals were the same as our signals, because you're at the CBOE and I was at the CME. So this was the sign for call.
Yep, that's what we had. This is call. What's a put?
Put was this one. And put. Then spread.
Spread, yep.
And then straddle.
Oh, yeah. I like
Strangle.
it. Yeah, strangle.
Squash.
What's a squash? I don't even know what that is.
Oh, yeah. It's a squash, like the squash, like when you're squashing the market.
Oh, okay. Is that a spread?
Yeah, it's like a spread.
Oh, I don't know that one. So
what about the funky chicken? Do you remember that one?
No, what's that one?
There is no funky. How many legs does a funky chicken have?
I mean, it's got at least a couple.
Yeah. When I was in the option pit, so they're like, Sandi, they're like, where's the 42-45 call spread, right? So that was the signal, 42-45 call spread. Yep. And I'd be like, oh, it's 2 bid at 3, 2 bid at 3. And then you have butterflies and condors. I forget the one for condor, but they're like, where's the funky chicken?
Do this. I love it.
They're trying to get me to do this. And I'm like, what the funky chicken?
What the fook is a funky chicken?
So yeah, I fell for it.
That's hilarious. I love it. That's really good. So now the other important thing here is you would do your size too with your hand signals too. And then anything facing into you is a buy. Yeah. Anything hands facing out is a sell.
Yeah. So price was always out here and then quantity was over here. So if you're trying to pay 5 on 4, then you're bringing it towards you want to buy. You're selling 4 at 5. You're selling it. So
So this was 4. And what's this? What's this? Sideways.
That would be 7.
That's 7, and 3 is 8, and 4 is 9, and 10 goes to another spot. Was this one 10?
Yeah. So 10. Ours were up here. 10, 20, 30, 40.
This is 100.
100 was here still, and then 200
for us was
300.
this.
This was 1,000 for us.
Yeah, 1,000 was this on our hand this way. This was 100.
Oh, those were 100. See, you'd be doing 1,000 lots over by us.
Sure, but yeah, this was 10. This is a 10. So if you did 20, 30, and again, my hands are facing in, so I'm buying 30. Right, if they're out this way, it'd be different. And if I had them this way, that's 8. right?
80. Yep.
80, and this is selling 80. So,
Yep.
yeah,
It's
that's
almost
what you
the
guys
same.
do.
So
So now I didn't have to rely on that so much because, again, my pit was the size of the studio I'm in. It was a little small pit, and there was like, at the time when I first started, there was like maybe, I don't know, 12 of us in there, let's call it. And then I moved to a bigger pit that had maybe 30, and then that pit was about 30 at its peak, maybe 50 on the high end. That was it.
yeah, I actually went over to the CBOE when I was working for BNP down in the S&Ps, and for whatever reason, they were short-handed at that desk, and so I went over to the CBOE, and I was there for a couple of days, and it was really kind of bizarre. It was kind of like you guys were like on this stage, and like we were watching you all day. It was just kind of weird, and
yeah,
remember that.
That's so cool.
Yeah.
All right, enough talk about how much fun we had in our past life. Let's get to the point of the matter here.
I know for sure we could go on for like hours.
We could go on for hours and tell stories to the cows come home. Okay, today we're going to talk about this option strategy from Spider Academy. I don't know if I'm saying that right, but it's in either SPX or SPY, right? Let's
yeah. It's the Spider Academy. So, the underlying market is the index, the SPX, and you can't trade the index, but you can trade options on the index.
Yeah. So what you mean by that, you can't trade you can't buy and sell the SPX cash. It's a cash price. It's not an asset where you own it. Like you can own spiders, right? You can, that's an ETF or whatever they call it, but you can own that or sell it short, but you can't do that with the underlying cash in SPX. It's just the number.
Yep. That's correct.
So having said that, what are we going to do? Are we going to go to the slides?
Yeah, we got slides. We got visuals.
Let's do visuals. I'm a big visuals fan.
Me too.
Would you look at this?
Yeah. So this is the tool. And and you can see on there that it is indicating, if you've been watching some of the previous episodes, you're starting to notice like, the yellow and the green vertical lines. And the awesome thing about options, this option tool, is it's going to give you the strike price.
So how does it do that? Can without giving away secret sauce, can you explain?
So we're going to take an algorithmic approach to trading these options and the signals that we generate and how that happens. And so we're going to first look at the stochastics, and then we're going to go on to vertical call spreads. And this is going to be the option strategy that we are showing signals to execute.
Okay, so you said the option strategy is, in this particular case, a call bull spread, so a debit spread on the call side. Is that right?
Yes, that is correct. So a vertical call spread, another name for it, is a bull call spread. And so when you're bullish, you want the market to go up. Right. And when you execute a bull call spread, you're going to be buying the lower strike and then selling the higher strike. So when that signal comes up on the chart, you're going to, and typically when it indicates it, and then I'm like, guess kind of letting out a little secret, is that lower strike price is going to be very close to at the money. Okay. So like right now, I think the SPY's trading at about like 580. Okay. So if we got a signal, it would be indicating to, it might be 580, might be 581.
Right. And how far do you spread those out? How wide is the spread?
Typically like four strikes.
$4? Okay.
Yeah. So it might be like you're going to buy the 580 call and then sell the 584 call.
Okay. Is there any magic to that spread? Is that in the algo, or is it something that you guys just like to do?
Yeah, that's part of Joe's secret sauce. Why it, when it indicates to execute that trade, and then the strike prices that it says to execute. Okay. So
yeah, I love secret sauce. No problem.
I'm not privy to that grandma's recipe.
Privy to the secret sauce. Okay, good to know. Now, do you ever use the corresponding put spread, like sell the put spread corresponding to the debit call spread? So they're both bull spreads. One's a credit, one's a debit. Does that matter at all, or you just like doing the call side?
Well, you know what? When in our, that's a really good question. Because there's a lot of different option strategies.
I said I made the question up myself. I I was thinking.
Yeah, I like your questions. Of course, this is your realm, right? You are the option expert.
I don't know, but okay. So go ahead. So what's your answer? Is there an answer, or is it just you just prefer the call side?
No, I have an answer.
Okay.
The reason why we mainly focus on vertical call spreads because it has a limited risk and a limited reward, and our focus is always, keeping the beginner trader in mind, and we want to limit their risk, and then we want them to have like a predefined risk, meaning what they paid for the option, which would be a debit, right? Okay. Like you had mentioned.
Right.
So
okay. That's just easier for them to understand, right? I said that's just easier for a newer person to understand that concept.
Right. So your risk is what you paid for that spread, and you won't lose any more than what you paid.
Okay. Got it. Good. All right. Good enough. Where are we on this list here? Sorry, I lost track.
No, it's okay. We can go to the next slide.
Oh, okay. Let's do it.
Okay.
Here we go. Oh.
So
stochastics.
Yes, stochastics. So the stochastics is a oscillator, and it's a leading indicator. So it's gonna, and it detects momentum, right? Okay. So it's gonna, again, kind of like it, when we're looking at the RSI, or we're looking at the signal line, or now we're looking at stochastics, is going to show you when the market is, oversold, and then, overbought as it's turning. So you want to, when you're doing this option spread, right, and you're buying this call spread, you're not going to really want to execute when the market is overbought, right? Okay. So you're going to wait until that comes back down, and then you'll see, and also the system will start to, indicate to you like when's a good time. So when we go over this in class, we always look at a 4-hour chart for the technical indicator, but this screener that you see, it is looking at multiple time frames. So right at the bottom of your chart, you'll see that stochastic. Yep. And we have not only the lines, but the little dots to kind of help you like see, the different green and red as it's turning. Yep. And then the multiple time frames are really important in this particular screener because it's showing you the weekly, that's the W, the daily, the 240, which is the 4-hour, and the 1-hour chart, which is the 60. And it's showing you, without having to look at all those different charts, clicking around, that what the trend is for those time frames.
Got it. So when all those moons align, you get a signal, like a long signal, let's call it, to get long or buy the bull call spread. Okay. Yep. And then you've got suggested strikes. And what about suggested prices? Is that part of it too?
No, I mean, the price is always fluctuating, right? So, you would go on to the Tradier platform, and you would go into the dashboard, and then click on the chains, and then enter in like SPY. And then you would be able to go and look and execute your trade. And we can show people like how to execute this as part of our class, is when you get the signal, how do you execute the trade? And so I can't tell you what the price is going to be at that time. It's going to be moving even while you're trying to execute it.
Okay. Got it. Cool. And do you guys use implied volatility at all to decide whether it's a good price or not really? You just like to get in?
We don't focus on, implied volatility or open interest. We'll go over it, and I know that there's lots of other, there's, the Greeks, the Delta, the Vega, and Gamma. And I believe on your trading platform, you'll be able to see open interest, implied volatility, and I think maybe the Delta, but I do know that those two you'll see in the price and everything else. So those are actually really important. But when it comes to utilizing our tool, we don't, we can go over and explain what that means. But when you're utilizing our tool, it's straight up, very simple, 580. It'll say 580 call, 584 call. You buy the lower strike, sell the higher strike, and that's it. And then you want to set a trade to get out.
Okay, that was going to be my next question. Am I getting ahead of slides here or no?
No, we can go to the next one.
Okay. So So let me ask a question about getting out. So when you get to the oversold region, do you get out? When do you get out of the spread? Does it up a certain amount percent wise?
Well, let's say, because I've been using those numbers, 580, 585, right? So you have 580 call, you buy. And so part of like selling that 585 call is that you're going to receive premium so that it actually reduces your cost, which is your risk for the overall position. So instead of just buying the 580 call for like $4, maybe, you're selling the 585 call for $2. And so now your net cost is $2.
Right.
You've reduced your cost. You've reduced your risk. You now know that by buying that 580 call, you have to now have it go above 582. And now your only profit is between 582 and 585, that $3. So you're limited to your reward on the upside because you sold that call. And we go over that stuff in the options class.
Okay.
So
cool. Awesome.
So I don't think I answered your question.
Well, no, I was going to get back to, when do you get out? That's always a tough part, I think, for newer options traders. They mostly can figure out getting in. I think they struggle with getting out.
So when you execute the trade, right? So now you paid $2 for it.
Yep.
And we say, now go ahead and get out. Set your target price to get out. And we say, if you risked, $2, then try to go for a 25% return on your risk.
Okay.
So you would put a sell order in at what, 250?
Yep. 250 is the right number.
And so now you've made 25% on your risk. Now, is that a lot? It depends on how you look at it, right? If you put more on, and you have more to risk, it can be substantial.
Yep.
But, when you're new and you're just trying to, get a handle on options and you're making 25% on your risk, it's still not bad.
It's pretty good. And what about the bad news, the bad side of it doesn't work? Do you have a similar 25% of debit expended to get out on the stop side?
So it's about the same thing. It's about the same risk reward.
Okay.
And when we have you put on the position, we usually have you go out about 10 days for expiration. So it'll be a little bit more expensive because of the time, but not too bad.
Okay, perfect. I love it. Cool. Did we talk about this slide? No.
So this slide right here is basically just showing you, an oversold condition. So, and then when it's starting to turn back up, so you can see that as it's turning up, the time frames are green now. Yep.
Cool. Easy to follow. I will say that. I like easy.
Yeah, it's really easy. So we always start with the stows, right? Or stochastics.
Yep.
And then, so the next slide will just show you an overbought one. And there's an example of overbought.
Everything's red. I'm all sad. It's all red. Although I like overbought too, though,
Yeah. You like overbought? Are you a bear?
I was a bear my whole life. After I got through the 87 crash, I was short deltas from 87 to 2005 the whole way.
Oh, wow.
Think about that. And the market did nothing but go up, technically. We had a few pitfalls and never really lost money the whole way through because, we had a different game. Our game was different.
Yeah.
But the downside is so much more. The velocity to a down move in our business is so greater than the velocity to an up move. And it's scary as hell, those downside moves, right? The 2008, real estate thing, that was a terrifying day. It really was.
Yeah.
That was scarier than 87 for me. It looked like the world was coming to an end.
Oh my God. Yeah. It's funny you say that because I actually felt the same way, that I was more of a bear, right? Because the market would go down so much faster than it would go up. So I just loved it. I mean, I would have dreams of long bars to the downside.
Oh yeah. Right. I know.
Yeah. But
no, that's the truth. And I always lean the short side because inevitably people would come buy puts from us. So I had to, I use my short deltas and just sell into those a little bit when I could. But yeah, that could be scary, I'd say.
Yeah. Joe is a bull. He's been trying to convert me.
Oh boy.
So, and these are his tools. So,
I like it. I like it. Okay. So this is the opposite of the oversold situation. This is the overbought side of the thing. You can see the red arrows or the red section of the arrows on the different time frames all pointing down. Might be a good time to get out of the trade if you're in this long, or would you establish a short trade or never?
No, we're never going to go do short options. We're always going to be just doing the.
Yeah. Could you do the bear put spread where you pay for that in this scenario? Or do you guys don't teach that?
We don't teach it, but like, if you start getting pretty advanced with options, you can start to, play around with like your own option strategies as you get more educated and stuff.
All right.
And so maybe if we ask Joe really nicely, maybe he can give us one of those technical indicators.
Okay. I like it. I want to come on and talk to the community and say, here's where Lex is getting short right here. And this is what I'm going to do.
I would be listening
twice as much as the average person.
I want to know what you're doing. You're the option expert.
I'll tell you when we're in the live session, I'll show you.
Okay. Awesome. I would love that.
Let's do that. You want to go to the next slide?
Yeah.
Perfect.
Okay.
What is this?
So vertical spreads, we've kind of been going over that, right? So if you look at this, you see the numbers, kind of a little hard to see maybe, but if you can see them, those are, that's the SPX. So, in that level, when we took that picture, I think that was, we first hit that level in February.
Yep.
And then I think we revisited it in April, almost touched it in August, and now we're up at like 5,800.
5,813 to be exact, thereabouts.
Yeah. So that picture was taken a while ago.
Yeah. No kidding. Okay.
So, cool. But you can see like the strike price, right? So if you're going to do the SPX, which it's a liquid market, but it's a little more expensive than the SPY.
You're going to trade one of these to every 10 that you do in spiders, right? It's a 1/10 ish.
Yeah, exactly.
Not ish, 1/10 without the ish.
Mm-hmm. Yes. Yeah. Yes. So it's going to be a little more pricey. But if you have an affinity for the SPX, you can trade this on anything. You can actually trade it on Microsoft or NVIDIA or some of the major movers in the S&P 500.
Right. I love it.
So it doesn't just work on the SPY and the SPX. It's whatever market has an option, which they all do.
I love that too. Good. Okay. Next slide.
Next one. So this is, and you can see this is a picture of the SPY.
Okay.
And because you can tell just by the number, or at least we can.
500.
So this is showing you the strike prices. So 534 at 538. So I mean, I'm kind of saying it in the way I would think of a bid and an offer, but really what it is, are strike prices, right? So you can see that there was a yellow line for a warning, and then the little bell went off, and you see the green vertical line, and it gives you the call strike.
And that's where you're getting in on that bell, and then it gives you the strikes. You get your price out there and let it rip, right?
Yep. You're always going to buy the lower strike call and always sell the higher strike call.
All right. I'm going for a suggestion here. Are you ready?
Yes.
Tell Joe this.
Okay.
How about if you made it even simpler and see the 534.2 strike?
Yes.
Put a little L out in front of that call, L call strike, and then an S call strike, so long and short, or B and S for buy and sell.
Yeah, like our positive or negative, right?
Yeah. How about those apples? Now people won't get confused at all. They won't do it backwards.
You know what? That's a really good suggestion. I'm going to 100% tell him.
You tell him Lex came up with that little bad boy.
We want to make it simple, right? We don't want people
right. Well, everything is so simple. I think that's even makes it even simpler. Don't confuse people. If they looked at this a newbie, they're like, "Wait, do I buy that one or sell it? I can't remember." But if there's a B and an S there, pretty good,
that's
right?
That's a great idea. We should totally put that in there. I appreciate you.
It's the Lex indicator. Go ahead, just name it what you.
I don't know how much we owe you for that.
Nothing. Just a cool, crisp high five. Perfect. High five. All right, that's cool. I love it. Okay. Next slide here.
Yeah, next one.
Okay, whoa, what's going on here?
All right, so now, like, as you know, we love high probability trade setups.
Yep.
So you will see in here where you have an oversold condition, right? The stochastics are low, they're under 20, and then boom, you get a trade signal. You have the yellow warning and then the green line, and it's telling you the strike prices and market's going up. And then we get a couple other ones, but and each one, like the first one worked out, second one worked out, those stills are kind of high. Do you want to keep on putting on those option strategies while that stochastic is indicating an overbought market?
Yeah.
It's still going to generate.
What's the answer? Yes or no? No?
Well, this is always going to be at your discretion. So it's still giving a signal. And even though, like, let's look at the third one, there's a red bar, but that doesn't mean that it was red when that signal went off and that you couldn't have executed and made money on that trade. It's kind of hard to see, like in a picture like this. But what we're really showing you is that, just an oversold condition going and then going up and the signals that come from it.
Okay. Got it.
While it's still climbing.
Very cool. Love it.
That's a 4-hour chart. So you're going to get maybe like one trade, a couple trades a month on a 4-hour chart. Maybe 2 or 3. So not a lot. It's not like a, high frequency trading type of day trading thing where you're going to be doing lots and lots of options every day or every other day.
I meant to ask you, you said stochastics that uses the 80-20 levels as well, like an RSI sort of, right? Is RSI better in some respects than stochastics or vice versa? Or are they about the same kind of indicator?
They're both leading indicators, both showing momentum. So trying to pick reversal pivot points. So, I'm glad you asked. If you look at the next slide.
Oh, see, it's almost as if we planned this, in which we didn't. I'm asking these like out of the blue without you telling me to ask them.
We are on the same wavelength.
We are on the same wavelength. I agree.
So this is
what's
actually
going on this guy.
So there's the RSI.
Oh.
And the RSI, we use that one with our futures masterclass, right? So if you had tuned in last week or the last episode, you would have heard us going over the RSI. Now, if you have the RSI with, let's say you have that one and this one, which would be the stochastics, you can see that now they're in confluence, right?
That's a mighty big word for me. Holy cow. You better explain that one.
So they're validating each other, and that is Joe's favorite word, confluence.
Confluence? I love it.
He loves that word. I said it for him.
I love it. Okay, so they're together. They're validating, you said, each other. Even more firepower to say jumpy jump.
High probability trade setup where you're getting the yellow warning, the green vertical line. You see that it's oversold in the RSI and the stochastic above. So those two indicators, are working together, and you see the number one for an execution. You'll see, so it starts to count. You see the numbers and the colors, and it all works together.
Perfect. Love it. Okay.
So this is a very bullish trade setup.
I like it.
And so for establishing a bull call spread, it would be optimal.
I see that. Very good. Okay.
So,
sorry.
Next slide.
Next slide.
Boop. And now we have added in the signal line.
Oh my God, there's all kinds of things.
So now you have the RSI, the stochastic, and the signal line all 100% showing an oversold condition, and that it's starting it looks like it's going to turn, in which it does, and they're all in confluence with each other, which is giving you this reconfirming signal of where the market might be going. It's a leading indicator, so it's trying to predict where it's going.
Got it.
So that's that's it. And then I don't know if the next one is the end.
Let's find out.
Oh, nope. Okay. So no. Okay, great. So this is a great picture. Okay. So, if you remember, so you're going to see the screener on the right, showing all the different time frames.
I got all greens and thumbs up. I'm rolling. I'm ready to roll.
Yep. So sometimes when you're watching this, real time, you'll see the weekly green and the daily green, and maybe you see like the 4-hour and the 1 hour red. But so the overall trend, long-term trend is up, but there might be a small pullback in the shorter time frame in which once those turn green, boom, you might get a signal, right?
Okay.
So it's showing, and then you have that momentum because, the stochastic's a momentum indicator, and you want that momentum because you don't need a huge move to capture that profit on a bull call spread, but you want to have the momentum and the market going in the direction you need it to go to be able to be profitable.
Perfect. Love it.
Yeah.
Very good.
So,
okay. Easy enough to understand.
Yeah. So you can see up there on the RSI, it says that it's at the upper. You can see that the signal line is indicating uptrend. You can see that the VWAP and the MAV, which are moving averages that we use for the futures, are also indicating bullish. You have every indication that this market is now about to turn to the upside from all the different tools that we provide to you. And if you use them all, if you got them all, they would all work together.
Nice. All right, good. Let's go to the next slide. Is there a next slide?
It might be the end.
Might be the end.
Oh, it's the end.
Okay, so what is this? Just a little recap?
Yeah, just a little recap. And it's talking about the Spider 7, that we have week meetups and videos and stuff. Well,
tell us a little bit about it before we close it down here. So just, if you join and pay the price, and I don't know if you can say the price, but there's a fee, a subscription to be part of this community, the Spider Academy. It is X, and if you don't want to say X, then don't say it. But if you want to say X, then say it. So this is great, though. So it's Spider Academy. You can join the community. I want to make sure people understand this. You can join the community, subscribe. You pay something to be part of the community and learn this stuff. You're going to get all of these tools to get in and, get out, let's say, and all that kind of fun stuff. But it's not financial advice. So we don't want to make you feel like these are the people instructing. You have to make your own decision based on the tools that are provided, which to me, and I can't say this enough, Sandi, because this like I know it, being a market maker is way different than being a off-floor retail-esque type trader. It is always great, and this is the plug for your system, to have a trade idea generator, something that could put you in a probabilistic positive atmosphere to make good decisions. Because otherwise you look at the screen going, what do I do now? Right? So, unless you have something that you're doing that's wonderful, then you need something like this tool to help you out, right? And I always tell folks too, if you can't read charts or you don't believe in that, okay, then try to create and learn spreads that take advantage of that. What did you say? Consolidation, the blue candles, okay? And if you don't know the direction, but there's a move, you can make spreads that do that too, right? There's a whole learning curve where you can make spreads that are reasonably priced, that give you a limited risk and a limited reward, but they're still pretty good to do.
Absolutely. Especially in options, there are lots of different strategies that you can make money on the market going absolutely nowhere.
All right. Sandi West from Spider Academy. What was it again? SpiderAcademy.com?
Yep. SPDRacademy.com.
SPDRacademy.com. Find them there. This will air down the road and we will let everyone know about it. All right.
Yeah. And Sandi, our offer is coming soon. Our offer is coming soon. So it's going to be good. So
I love it. Sir. Awesome. All right. Good to see you again. We'll talk after. Okay.
Sounds good.
All right, Sandi. Thanks.
Bye-bye.
Bye.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.